So we've lost 25K, we've lost 2690, 30 years at a 1-month low. Where does this go? How long do we need to work this off, the rally we've had?
Yeah, I mean, we think January's rally was really just an unwind of the extreme pessimism from December, and so it was very, very much justified. The economy slowing and not stalling, trade tensions are slowly diminishing at the margin, and the Fed is on pause. All right, but now we know, right? We've unwound that extreme pessimism. Now the bar is substantially higher, and the market is very, very sensitive to any sort of confirmation of this base case. I think this week, honestly, we didn't get too much new information. We got some rumblings around trade, but not too much, frankly. I think the most important thing will be the continuation of the trade talks ongoing next week, as we know. And next week, I'm also watching the inflation data for a confirmation of that Fed pause. So I think it's a little bit harder. It's a higher bar now.
Is the market pricing in tariffs going up March 1 or not? Or is it more about an elongation of this as a dynamic, as an overhang?
Well, what you're starting to see is the U.S. dollar price in tariffs going up. So every time we get this leg up in the dollar, we see volatility in the markets and downturn in the markets. So in essence, what we need is the world now is saying, okay, the market's saying it's a growth-starved world. And last year was all about the U.S. decoupled from the rest of the world, and the dollar rallied, and that was disruptive for markets. What are we dealing with now? Concerns about European growth, concerns about trade. We know the U.S. is slowing, but it's going to be okay, so you get another leg up in the dollar and more market volatility. What do we need? We need the slowdown in the U.S. to continue, and we need China to stabilize growth, and they're working hard to do that, and that should be supportive of European growth, and that should take some pressure off of the dollar. Until we get there, markets may be volatile.
I mean, what's going to be the biggest factor over the next few months, Gabriela, for the markets? Is it trade, the Fed, or earnings? Because they're all kind of pointing in different directions.
I would actually agree with your point that it is a continuation of this base case that we laid out, but actually the new important information is not here in the U.S., but it's actually overseas. So for me, the most important kind of variable here for U.S. markets, U.S. earnings, and for global markets is actually the China question, right? We continue to see some signs of softening in Chinese data, the manufacturing PMIs, services PMIs. We need to see a floor in Chinese data. We do think we'll get it. They have been really stepping on the accelerator here over the past few months, but that's the new information we really need that would be very, very powerful.
And then, so what does that mean about, contrast that with concerns about Germany, for example, that are tied to China?
They are, and it's an export-driven economy, and, it's China stabilizes. We saw it in 2015 into 2016. China stabilizes and accelerates growth, and the rest of the world does better. We're not going to see that type of stimulus out of China this time. We'll see lower reserve rates, maybe some fixed investment, nowhere near what we got in 2015. But you don't need that because it's at a time when the U.S. is slowing. So all you need is a stabilization back towards some reasonable level of growth. There we say trend in China, and that should be supportive for Germany and the European exporters.
But do you see this as a moment where we could, I don't know, put 10% tariff on European cars, right? There's more reports about friction there now today.
Well, look, I don't know if any of us have absolute clarity on where we're going with trade. What I would say is all cycles die from a policy mistake. Typically, that policy mistake is going to come from the Federal Reserve. That seems to be off the table right now, and I believe that is right. Inflation is benign just about everywhere in the world. If we go down the path of making a policy mistake with regards to trade and the dollar appreciates significantly as a result of that, then yeah, the economy is going to be in some trouble and corporate earnings are going to be in some trouble. If we don't make a policy mistake, given where we are, given where the fundamentals are in this economy, this cycle should go on for a very long time.
Small caps or large caps, Gabriela? We're in a period where small caps are outperforming again so far this year, after sharply underperforming last year.
I would say we're somewhat agnostic between the two because you can do check marks and question marks for both sides. For small caps, the one concern we have is around leverage, right? Those do tend to be the companies by market cap that have built up a little bit more leverage over the past few years, and that is starting to become a bigger concern for investors, the actual quality of companies. On the other hand, as we mentioned, the U.S. economy is slowing but not stalling, so it is still a positive environment on the revenue front for small caps. So I would say we're agnostic between the sizes.
Over the next 5 years, if you were to do a building block approach to return expectations, you would see on a relative value perspective, small caps are about 1% cheap to large caps. So you would add that as a premium. So over the next 5 years, small caps should probably outperform. Small caps, I mean, a lot of it's going to come down to trade. They do source a lot of inputs from around the world, and that was a headwind last year as we're rising rates. I don't expect rates to go up this year. Growth is slowing. I expect some reasonable outcome on trade, and that should bode well for small caps given that they are reasonably cheap compared to large.